A business combination occurs under one strict condition: an acquirer must essentially obtain complete control over another entity. The most straightforward mechanism for establishing this control is the voting interest entity model, or VOE. Here, control is a simple matter of math: direct or indirect ownership of more than 50% of the outstanding voting shares. But ownership isn't the only way to dictate terms. The alternative mechanism is the variable interest entity model, or VIE. Under the VIE model, an entity exerts financial control without holding a majority of voting stock. This happens when a parent company has the contractual power to direct the subsidiary's activities and absorb its losses or benefits. This brings us to the core thesis of consolidation accounting: substance over form. A parent and its subsidiary might exist as legally separate corporations for decades. But to external users evaluating financial health, those legal boundaries are irrelevant. They must be reported as a single economic entity. To accurately build that single entity on paper, we have to follow a strict timeline. First, we derive the consolidated financials at day 0, the exact date of acquisition. Then we account for year 1, handling ongoing operations and internal eliminations. Consolidation functions as a mathematical fusion, stripping away individual reporting lines to reveal the true reach, resources, and risk of the controlling interest. We begin at day 0 using the acquisition method. The first mandate of this method is to determine the exact acquisition date, because that timestamp sets the baseline for every calculation that follows. At the moment of acquisition, the parent company completely ignores the subsidiary's historical carrying amounts. The old book values are erased. Instead, all identifiable assets acquired and liabilities assumed must be remeasured at their acquisition date fair value. This revaluation often leaves a gap between the price paid and the tangible assets received. We calculate goodwill by taking the fair value of the consideration transferred and subtracting the new fair value of the identifiable net assets. This table shows a target entity before a $900 cash acquisition. Notice the difference between carrying amount and fair value. We subtract $200 in current liabilities from the $900 total assets fair value, leaving $700 in net assets. The $200 premium represents goodwill. With the individual values established, we apply the rule of combination. The parents' and subsidiaries' assets and liabilities are added together at exactly 100% of their fair value. This shows the asset section of a consolidated balance sheet. The parent and subsidiaries' assets are stacked together. Under non-current assets, we add the newly measured elements: the $25,000 excess fair value for land and the $25,000 of newly calculated goodwill. Because we acquire these net assets at their day 0 fair value, there is a vital trade-off. The subsidiary's historical equity accounts, its prior stock and retained earnings, are completely eliminated. They do not survive the consolidation process. Moving from the static day 0 balance sheet to year 1, the combination becomes dynamic. After the acquisition, all operational line items, revenues, expenses, gains, and losses, must be added item by item. However, a parent company rarely buys exactly 100% of a target. The portion of the subsidiary not owned by the parent is called the non-controlling interest, or NCI. This minority stake must be carefully accounted for as operations continue. This image provides separate and consolidated year 1 income statements for Platonic and its 80% owned subsidiary, Socratic. Standard operational items seamlessly merge. Platonic's $250,000 in sales plus Socratic's $120,000 sum cleanly to $370,000 in consolidated sales. The critical step happens at the bottom. Socratic's standalone net income of $26,000 is bifurcated based on ownership. The 20% belonging to minority investors, $5,200, is segmented into its own line item, separated from the parent's $59,800 share. This segregation extends to the balance sheet, where the total non-controlling interest is reported as a single, separate line item, strictly within the equity section. The consolidated income statement projects the total economic power of the combined entities, while simultaneously protecting the mathematical truth of what rightfully belongs to outside minority shareholders. Once we combine operations, we run into the single entity axiom. An economic entity cannot owe itself money, nor can it generate actual profit by trading with itself. Because of this, all intra-entity balances and transactions must be eliminated in full. And this requirement ignores the NCI percentage. Internal friction is stripped out at exactly 100%. King owns 70% of Simon. King has $450,000 in liabilities, and Simon has $200,000, summing to $650,000. However, Simon's liabilities include a $100,000 note payable directly to King. This internal debt is removed, resulting in true consolidated liabilities of $550,000. We apply this exact same elimination logic to intra-entity inventory. If one entity sells goods to the other at a markup, any gross profit recognized on goods still sitting on the purchaser's shelves must be completely reversed out of consolidated net income. Eliminations act as a strict regulatory filter. They strip away phantom internal volume to reveal only the true external performance of the conglomerate. This filter also applies to the flow of dividends between consolidating entities that hold reciprocal equity stakes. Internal dividends, whether the parent is paying the subsidiary or the subsidiary paying the parent, are merely shifting cash from one pocket to another within the same pair of pants. They do not change the entity's overall wealth. When preparing these statements, which dividend transaction actually reduces consolidated retained earnings? Consolidated retained earnings are only reduced when cash actually leaves the single economic entity, specifically when the parent company pays dividends to third parties, which is answer C. Eliminations preserve the integrity of the single economic entity by zeroing out internal friction, leaving only external interactions to impact the consolidated bottom line. The architecture of the consolidated entity is now fully assembled. We've adjusted the acquired assets to fair value, recognized the premium as goodwill, isolated the non-controlling interest, and erased the subsidiary's historical equity. We've also purged the false volume, dissolving all internal debt, internal inventory margins, and reciprocal dividends into nothing. This rigorous process separates full consolidation from lesser investments. If a company uses the equity method, holding 20 to 50% of the voting stock, they have significant influence but not control. Therefore, no line-by-item consolidation occurs. It is also distinct from the proportionate consolidation method, which is strictly reserved for the shared assets and liabilities of joint ventures. The acquisition method exists for a singular purpose: to force compliance with economic truth over legal fiction. Full consolidation demands 100% aggregation of fair values and 100% elimination of internal friction. Only then does the ledger yield an accurate financial picture of a